Hey traders, Raghee here. Welcome to Charts and Coffee. Great to see everyone. Happy Tuesday. Happy Jerome Powell Tuesday and Wednesday. Really, we've got a 2-day extravaganza of, let's just call them shenanigans, coming up as we have our Humphrey Hawkins testimony Tuesday, today, starting at 10 a.m. Eastern, and then tomorrow as well. So you can see that right there. 10 a.m. is an interesting time because at this point, the clearing period has completed, that 30 minutes between 9:30 and 10 a.m., where we see the flood of orders being filled, a lot of volatility. And then right at that end of the clearing period, boom, here comes Powell. And I'm really happy that yesterday we had a nice day trading morning. But ultimately, I would say that let's be really cautious. I mean, today and tomorrow are 1000% caution days. If we're going to venture into trades today and tomorrow, especially today, tomorrow, the day two follow-up usually isn't as full of fireworks as today could be. We want to keep an eye on the target rate probabilities over at that CME FedWatch tool. Do those align to a more hawkish outcome? Do they align to sort of where we are right now, which is 5.25 to 5.5? Ultimately, are minds changed, or is there clarity as to 5.25 to 5.5? Is there any clarity in terms of whether or not June is when rate hikes complete, or do we still entertain the notion of possibly July, the July meeting? So those are all things that are most definitely going to be part of the conversation. And then we do have the initial release of some jobs data, ADP on Wednesday, JOLTS on Wednesday, all culminating in non-farm payroll this Friday. So lots of hot zones scheduled, high volume, high volatility events this week. Pretty darn important. So again, exercise some caution or lengthen the time frame. One of the things that we might find on this caution day, we want to trade with smaller size. We want to trade more moderate to conservative levels. We don't want to be as aggro as we might be had Powell not been on the calendar. One of the things we can do is take the time frames that we're looking at and just sort of lengthen them to a point where we can now think about, all right, well, can a 1 hour time frame better handle the volatility? Can a daily time frame better handle, not even better handle, but could we possibly get opportunities that are going to be unique to these? Could this 2-day event be the catalyst for, and let me show you here, moves that I would absolutely, if I can confirm with structure dictates strategy, but I would absolutely be open to opportunities in the daily price movement range. Remember, so now we're talking about the daily historical volatility, giving us a zone. And yeah, if it's going to take something more severe, meaning Powell, to get us down to those opportunity levels, I'm game. Bring it, right? That might be exactly what we need for a slightly more exaggerated, larger moves to oversold levels or retracements of trends. So let's be aware that a longer term time frame might be exactly what the doctor ordered for events like this. All right, so that's what's on the radar, not just today, not just tomorrow, but this week, and also the time frames that I'm going to be using to continue to monitor, events like this. Do I want a day trade? We were very active yesterday till about 10:35. That's my typical cutoff. And then we say, all right, what sectors, what futures contracts, which currencies, which stocks could benefit from Powell triggered volatility? Couple two symbols that I would say be very cautious with, gang. So this is just a little bit more of a risk-oriented heads up. Be very cautious with the 6E and the dollar. Be very cautious with bonds. And I would say relatedly, be very cautious with gold. In fact, if anything, maybe for the next day, tomorrow, different conversation, but at least maybe today, maybe avoid those if higher volatility events, higher volatility swings are not your cup of tea. So just something to think about there. All right, so that is what I've got kicking off the morning. As always, type in your questions and we'll tackle them one by one. I see from our trading room, Pierre asks about Meta. Sure. Meta's actually been a really good shorter term stock for us. It's had a great overall trend since late Friday, and that continues on that 1 hour. So mean reversions and or daily price movement range buys are most definitely on that 5-minute chart what I would focus on. But you know what? The daily saying, hey, don't forget about me. I'm trading above the 200 propulsion. I've got a green multi-trend uptrend reading, green grab candles. Dips are buyable, but how are we defining the dips? What is a dip? What is a retracement? What would be the mean reversion? I think on the daily, that's going to be as good a spot as any. And that's going to put our opportunity weighting at about 184.30 to 182.40. That would be what I'd keep an eye on as we get started. Now, remember, gang, with Powell coming up, it's not going to be surprising that we might see market participants say, you know what, let's just see how this goes a bit. Let's not front run Powell. Let's not front run whatever he's going to say. So please be aware, gang, there could be a little bit of, let's wait and see what it is. What kind of mood did Powell wake up in? Did he wake up and choose the less hawkish route, or has he woken up and chosen violence? We don't know. We will find out. All right. So it's definitely, remember, gang, trading is counterpunching. Trading is about remembering we're the batter at the plate, not the pitcher on the mound, right? We're reacting to what's being thrown at us. And as long as we keep that in mind, we'll wait for trades to come to us. All right. First question from our YouTube channel. Gypsy, how are you? Thoughts on UUP for a swing? Gypsy, probably not till tomorrow. I will not really take any dollar trades until I get a better read from what it is that Powell wants to say and do. But if there is a swing, again, overnight position, likely a couple of days, if not longer, follow through. I'd like to be long euro, which is to say I'd like to be short the dollar. And then to your point, UUP, absolutely a great candidate for puts into resistance if the euro can sink down to support. Absolutely game for that. Yeah, Stacy, I'm with you. Should be an interesting day. Right. Should be a very interesting day. All right. Next up is, short week, says Sergio. Yeah, that's probably not a bad idea. If you've been wanting to work on your golf game or take your mom to lunch, this is the kind of week, if you want to go read a book, this is probably the kind of week where if you come back on maybe Wednesday afternoons close or come back around Thursday, probably not a bad idea at all. All right. Do want to remind everybody, if it's not already clear, here on the screen, right above my head, you'll see the link where you can register for tomorrow's webinar. New chart examples, new everything, gang. Second webinar for our upcoming class on March 11, diving into the 1 hour, diving into the daily, diving into how to take advantage of volatility using daily price movement ranges, using mean reversions on 1 hour. I think a lot of folks think, well, Rog, what about the wave and grab and Darvis? Absolutely. They always come along for the ride. There is no way that I would ever make a trading decision without the grab, without the multi-trend. So these are always going to be those staples on my screen. But then if we can start to add other factors, other dimensions of the market, like volatility, especially in those longer term timeframes, there's been a lot of really great clarity there. All right. Let's go ahead and next up is, can I talk about relationship of bonds and equity? Still confuses me. Thank you for the question. And Tropic, I would say this. There is a lot of, and I'm actually surprised I hear this as often as I do. If you look back on historical relationships, and I don't mean 5 years, 10 years, I'm talking about 40, 50 years. If you go back and look at the long bond and you look at indices, there is this odd, and I hear it persistently, that higher bonds, meaning higher, I should say higher bonds, meaning lower yields, are somehow not bullish to equities. Let's look at it this way. And I think this is the easiest way to clear up any confusion about what modern monetary theory, MMT, what was started by the Bernanke. It was as a reaction to '08. How do you monetize debt? How do we get out of the financial crisis? Very different monetary policy erupted from that time. And Yellen continued on, and Powell has continued on with it too. There's a lot, I don't want to sound like an economist, but this idea that we can print our way out of trouble has been in effect now since '08. That's what we've done. Lower yields do a couple things. One, think of it this way. If you can't get decent yield at a corporate, at a junk, if you can't get decent yield at a bonds, what is the choice that a money manager or an investor or whomever has to route their money into the market for a decent return? It ends up corralling money into stocks as really being one of the only places to see a return. So lower yields, what companies love cheap money, right? Investors love cheap money. So cheap money triggers its own type of reaction that's good for equities. But cheap money also eliminates the possibility, or at least reduces the likelihood, that traders and investors are interested in yield. They'll look for equities. So the general gist since 2008 really is, if yields are down, meaning TLT is up, meaning ZB is up, because the direction of the market, TLT or ZB, and the direction of yields are inverse. So as those markets head higher, yields head lower. Equities are going to generally like that. They're not always going to be in sync, but equities are generally going to like that. So that's the relationship. Just remember, does the stock market like cheap money? It does. It absolutely does. And again, it's not about always. It's all about what type of behavior does it tend to create. And it might take a little while to see it at scale, but generally speaking, that's what you will see. Right? Okay. Next up is, hey there, Rolex. Raghee, I got to applaud you for your consistent trading. I appreciate that. Thank you. That's my job, right? I appreciate that, though. Rolex, watched a webinar 10 years ago and heard you talk about grab candles, 34 EMA wave, etc. Rolex, I appreciate that. And if you look 10 years before that, my wave colors were a little different, but they were still there. No, I appreciate that. I think the main idea here is, can we root our trading analysis and decision in timeless tools? We all stand atop a giant. I learned what I learned about volume and about underlying market trends from reading the work of Charles Dow, from reading the work of Richard Schaubacher, from reading the work of, say, Wyckoff. Those folks were trading in the early 1900s, mid to early 1900s. And when you have to Darvis was the 1950s and 60s. That's the most recent influence, if you want to look at it that way. When we look at timeless stuff that's been working for over a century, there's a certain confidence you'll get from that. I'm not necessarily looking for something new. I'm just trying to take the four factors: price, time, volume, and volatility, and find ways to automate what they're telling us, right? I think that's the wonderful privilege of trading now in this age of technology, where we can say, I don't have to quite do as much manually. I can automate this, decrease the learning curve, and increase my accuracy. And so I really appreciate that. Thank you. All right, DocU. Hey there, Otis. DocU is looking interesting. Okay, let's take a look. So if I'm looking at DocU, it just came off. Let me show you what a setup is for me, Otis. I've got a support level by way of the automated Darvis. If you're looking for automated levels, gang, if you're looking for levels that you can say, you know what, I don't have to use any discretion, I don't have to draw this myself, that's an automated Darvis. I just highlighted it there with my own drawing tool, right? And then if I combine that with another tool, all right, there's a neutral underlying trend. Thank you, multi-trend, for automating the market structure for me. I'm not having to look at moving averages, crisscrossing and testing this. And nope. What's the structure of the market? Traffic light simple. Now I know an oversold stochastic, which we can see happened right in these two candles, is what sets up a buy. How do we know a buy? Respect the trend that was. What was the trend that we had before we went neutral? It was up. So that trade is already fired off out of that Darvis area. And then, yeah, I think that when I look at the stochastic, which is what's here, and we have this 50 midpoint, if we're going to see follow through, then that's a little bit more of a momentum. Remember, this is more of an exhaustion setup. Follow through would be momentum. We really need to see the stochastic continue to move higher through that midpoint. All right. And that would be excellent. That would be excellent confirmation of potentially continued movement higher. All right. Next up, thoughts on Apple. All right. Let's take a look. All right. So the question is, I've got into the 150 puts yesterday that I only plan to hold overnight. Would it be worth holding longer? Puts? Am I reading that right, Robert? Robert, I can't buy puts in this environment. On one hand, we're in a range, right? It looks like we're in a range. On the other hand, I've got an oversold stochastic with a neutral environment that's coming after a, and I don't know which time frame you're on either, Robert, but I don't have anything. So here's what I will say. When we look at a setup, we have to ask ourselves, what's the underlying market behavior? So in this environment, the only thing that I could say would possibly help me with what essentially what a short position or expecting exhaustion could do next. I think staying below, maybe testing this level and staying below it would be key. Exhausting at the 50% would likely be key to push us back down into the range, right? But I'm actually not allowed to, based on the structure, based on the tools, based on the automation, I'm not allowed to be short in any way. And that includes being long puts, if I'm understanding your question correctly. And as far as holding overnight, here's what I would tell you if you're in the Sector Secrets room. What did you pay? Of that option, what are you willing to risk of that premium? And what risk is it to your account? And every one of those questions should have a threshold. And as long as you're working within those thresholds, that's what I call the holy grail, position sizing, risk management. As long as you're working within those thresholds that you predetermined, my thought is then it's within an allowable amount of risk. All right, FCX. Do I like FCX? I would like to be long FCX. I don't have a setup yet on the 1 hour. Although if we continue to move lower, that might be a different conversation. We're sort of in no man's land right now, Wiley. I would like to re-engage FCX. It's been good to us on and off, whether that be day trading as a proxy for copper, whether that be simply trading FCX and its movement with XME and SLX, those two metals and minings ETFs. So ultimately, what I want to remember with something like FCX, and my mastery members, you know what our plan is here. But if I'm looking at this here now, today, it's in no man's land right now. So there's nothing I would do here today. All right, Wiley? All right, next up, do I think premiums will burn normally at open, or will they hold until Powell talks like they do on FOMC days? I trade iron flies at the open, but they don't work if there's... it really does. Brandon, I think it really does depend on what he's going to say. But remember, when we know that Powell's on the schedule, with which any options writer is already keenly aware of, the implied volatility associated with buying those options, especially in, say, the last week or so, would have been completely elevated. There is absolutely a higher likelihood of an option that's bought, right? Or if it's sold, whichever side of it you're on, having that higher IV crush likelihood, depending on when expiration is. So my thought is, I don't look at today's hot zone any differently than I would any other day's hot zone, in that I'm expecting an IV crush type situation, especially for options that were bought in close proximity to today's hot zone. I hope that makes sense. I'm not a fan of, do flies. I don't write premium. So I might be the wrong person to ask. My thing is directional debits, long calls, long puts. That's my focus. So IV crush is going to affect us all. Ultimately, I just, as a buyer of options, I know that I'm especially susceptible to buying an elevated cost, right? Higher cost option, merely because it's going to have to deal with the volatility of Powell. And that's why I will typically avoid it. I'll do the same thing with earnings. I'll do the same thing with any of these kind of hot zones where the IV, the implied volatility that I'm going to end up paying for, leaves me very susceptible for that dramatic letdown in premium value. Okay, gang, that's it for me. Thank you as always for being a part of Charts and Coffee. I will see you all on Wednesday, 8 p.m. Eastern. And we're going to continue our conversation about how we will wrangle the volatility, how we will find the clarity in the trends in this year, in 2023. This is my trading plan. This is the time frames that I'm looking for. And this is the approach that I'm going to continue to focus on. All right, gang, be good to each other. I'll see you tomorrow. Same time, same station.